Good morning. Welcome to another episode of Ridiculous. And as you can see, we're trying trying something new today. So now you can actually see the screen, which is great. It's possible there's a little delay between on the stream, but anyways, we're ready to go. Okay, so yesterday we were looking at a variety of different companies. And I think one of the last one we were looking at was maybe Saker. I think it was Saker. They do the helicopters. They're the guys managing the helicopter landing pad. Anyways, looks like this morning the Fed's holding interest rates steady, and so that is going to be probably the thing that dominates the market conversation today. But we don't think of those terms, so we're going to just keep plowing away, seeing what we can find in terms of actual companies to buy. Alrighty. So we are going to, and so we use tools that are, for this program, we're using tools that are free so that everyone's kind of on the same playing field, the same page, and no one's wondering, hey, what about, I can't afford that tool, what should I be using, blah, blah, blah. These are all free tools. These are all free processes, or maybe you have to sign up or whatever, but basically you can do it. Doesn't matter. As long as you have an email address, you can do it. Okay, so the next one on the list, Glen Burnie Bancorp, GLBZ. Okay. What do these guys do? Or bank, regional bank. So it's a commercial savings bank. Looks like they're based in Baltimore. Okay. $14 million, 7.5 times earnings, 8% dividend yield. Investor relations. Okay. So now we are just going to pull up the basic information. If we can, all SEC filings. Here we go. Yes. Okay, it's like the latest quarter and the latest 10K. Okay, so this is a bank. It's a regional bank. Balance sheet first. So these are loans. So their balance sheet is about 360 million total. Non-interest bearing deposits are about just under half interest bearing deposits. Okay. They have a defined pension. Oh, no, a defined pension. So they have some short-term, they have $50 million in short-term borrowings. I suppose that's wholesale funding, but we can find that out. And trading for 1 times book. So about 17, maybe less than 1 times book. Less than 1 time. $14 million market cap, $17 million book value. So, question is, so this is June. This is as at June. Let's look at what the income statement looks like. Yeah. So 710 million, 6 months ended. Maybe they're on track for, who knows, 1.4. So 10 times earnings. Maybe selling it. Perhaps 10 times earnings. 1.4 million for $2 million market cap. But you have to look closer. So that net interest margin, that is healthy relative to revenue. Like they don't pay a lot interest. Interest and dividends on securities. Okay. Fees and commissions. Good business. They do, however, have hefty salary, so it's very personal service, or presumably would be. Don't know. Okay, so what are we going to check first? Well, we know that the dramatic rise in interest rates has caused other banks to get smashed. And the reason is because duration has been terrible. Now the question is, has that finished? So their investment securities, they've taken a pretty big hit, $27 million gross unrealized loss on $178 million book value. Not awesome. Most of that is in agency-backed mortgages and muni bonds. So agency mortgages and munis are the bulk of the portfolio. On top of that, you got U.S. government after. So depending on what they're buying, seems reasonably safe. Do they give you relative reasonable duration information? They do not. They do not. Continuous rate. Okay. Okay. Here's the actual maturities. Yeah. So that's the bad part, right? Of the 178 million amortized value, amortized cost, they have 100 million, basically half, in 10-year plus, and then another 30 million in 5-year plus, and only 25 million in within 1 year. So okay, so their investment portfolio seems like it's probably okay to to credit, but duration is terrible to take advantage of the current cycle. Right? What else? What else can we see? Okay, loan portfolio. Vast majority is residential and commercial loans. Okay, so pretty plain vanilla. Okay. We think we get it. Yeah, we think we get it. So it doesn't appear that there's currently anything overtly special about this bank. They pretty much made the same decisions and have the same flavor as basically any other regional bank. They make residential commercial loans. Their investment portfolio, the investment portfolio is too long in duration. And they stretch for yield, and they're getting about half. Obviously, that's long-term opportunity. So there'll probably be a time. Okay. So they operate a commercial bank with 8 offices in Anne Arundel County, Maryland. It's got 8 branches. So it's an 8-branch bank. Book value per share, $6. Currently trading $5. Down 5%. Are they paying dividend wise? Says First Community Corporation. Yeah, so these. Yeah. Okay, so trading below book, lots of capital, regulatory capital, but return equity is not great. So what would be the opportunity here? Yeah, so we're gonna pass. Doesn't seem like there's anything special. So for example, Bank of America, right? Massive. Now their losses on their portfolio, something like $100 billion. Remember the last. I'm pretty sure. Here we go. Okay, so gross unrealized losses at September 30th in debt securities, 136 billion, up from 100 billion in 2022. So Bank of America, 200 billion on market cap, right? So most of that, where's that coming from? It's held to maturity, agency-backed mortgages, and U.S. Treasury. So the $100 billion of that, basically all of it, more or less, is coming from U.S. Treasury, long-dated U.S. Treasury and agency mortgage-backed securities. Right. Okay. Current market cap is 200 billion. Why are we looking at Bank of America now after looking at this Pipsqueak Bank? To illustrate a point. And what's the point? The point is that the higher rates, the unrealized losses, as long as it's credit good, they're going to unwind over time. Right? So it's going to slowly bleed into income. Unless, of course, interest rates decline, which this Fed pause today maybe lends it a one more story. Anyways, we like situations where you can afford to be patient. So if some of these banks are good and the unrealized losses have already appeared, so the balance sheet's already taken the hit, and the Fed is looking to pause, and it starts to become more interesting to look at, right? It starts to become more relevant. Like you don't need a lot of this to reverse. If 10 or 20% of it's reversed, that's 20% of the market cap in equity that comes back overnight, which is huge. The other shoe to drop is, of course, going to be, just the general economy, which is, what interest rates have caused. So, does it pay to be early on this? We suspect it does not. We would guess. We would guess it does not pay to be very early on this idea. If you have a general recession due to interest rates or war or whatever, then these banks are going to there'll be another leg down, so to speak. Anyways, something to think about. But for now, nothing that we pursue. All right. Next on the list, Clear One Inc. Who's Clear One Inc. and what do they do? 14% dividend yield. Usually not a good sign. Technology and communications equipment full time. Designs, develops, and sells conferencing, collaboration, and network streaming solutions for voice and visual communications in the United States and internationally. Company offers a range of audio conferencing products, including professional offer. Okay. 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 So what do these guys do? Clear One Inc. What do they do? Home office solutions. Fatigue free. Professional camera choices. So this is usually a bad sign. I still can't tell what they sell. Do they sell cameras? Do they sell software? Video collaboration. Cloud collaboration. Convergence AV manager. Okay, so they do have some. They sell camera. They sell professional cameras. Camera speaker. Okay. So they sell hardware. They sell some software. Cloud-based video collaboration. Okay. Legal. Did they get the money for? And more importantly, where the hell did it go? Okay, so they lose money in their operations big time. Okay, still losing money. Paid it as a dividend. Got $55 million in. They're losing money. And they decided to pay out as a dividend. Okay. That doesn't make a lot of sense to us, but sure. And they still have debt in the books. Google set. Recognition of legal settlement of contract dispute. From receipts and legal settlements. Settlements, plural. Why are they suing so many people? But they spent $21 million on legal expenses. Unamortized, capitalized. They capitalized legal expenses. Wow. That's aggressive. Or it seems aggressive. Unless they were very confident. They won, but okay. Okay. The company and another party entered into a confidential settlement agreement, license agreement. In terms of litigation parties were dismissed with prejudice. Subject to litigations. Early June. But what was the note 8 for contingencies and commitments? Intellectual property litigation against Shure Incorporated. Okay. Did I even describe what it is? Okay. Also, is patent infringement. Okay. Anyways, it's trading for 15.8 million. They already paid the dividend from the legal settlement, and they lose money. Books. Right? What do you got? 15, 21. 25. 8 million in liabilities. Some marketable securities, long-term inventories, usually not a great idea or sign. Yeah, so go space or whatever. Should pass. We'll pass for now. So, incorporation. Profile. Apparel manufacturing in New York. Design, merchandise, and sells luxury apparel. Investors in the United States internationally and operates through Vince Wholesale, Vince Direct to Consumer, Rebecca Taylor, and Parker. Range of women's products such as cashmere, blah, blah, blah. Okay. Well, they sell a lot of it. $300 million. make no money doing it. So that's usually not a good sign. Let's see. Okay. Balance sheet is not fantastic. Basically no cash. Lot of debt. Not great. Gain on sale of intangible assets. I see. Okay. So the income is because they sold something. 30 million bucks. What is the market cap here? 16 million bucks. Right. Got it. Got it. Cash flow. Yeah, they don't make any money. They got a big check from these selling intangible. They're selling assets. They live off their credit facilities. Repayments of borrowings under the term loan facilities. Okay, so they sold off a bunch of some assets and paid off some debt. And they still have no cash on the books. That's pretty bad. Intangible. Philip Parker intellectual property. Sale of Vince intellectual property. Membership interest. APG Vince. Now remember, the name of this company is Vince Holding Company Corporation. So they sold their namesake. Not great. So we are going to pass. It's Rebecca Taylor and Parker. And it looks like they sold a bunch of those. Nordstrom's. Yeah. Why would this new company do better with the ABG Viking? Yeah. Looks like they need to sell out to cover their liabilities. Yeah, lots of sales, but they just couldn't make money doing it. Okay. It's possible. So they retain this membership interest, whatever the hell that means. Sold this thing. Looks like they sold their main asset. And they retained this 25% interest. So if let's assume for a second it's like they got a stake in the asset still. See note 15. deal, right? The buyer issuing units of buyer to seller, representing 25% ownership stake in buyer. Okay. So they sold. Who is Authentic Brands Group? Brands Group, brand management company. They are quite big. Owner, CVC Capital Partners, HPS Investment Partners. Okay. American Brand Management Company, 22.5 billion revenue. That's so these guys are massive. These guys are massive. They own Aeropostale, Brooks Brothers, Forever 21, Nine West, Nautica, Prince, Reebok, Tap Out, Vision Streetwear, Thomasville. Owns more than 50 consumer brands both. Hmm. They acquired the rights to the likeness of Marilyn Monroe. Juicy Couture acquired the estate of Muhammad Ali. Elvis Presley. Wow. Shaq signed a likeness and marketing rights deal. Julius Irving. Hmm. These guys are serious players. They own a lot of stuff. May 2020, they formed Sports Illustrated Studios. That is a big portfolio. Okay. Buyer paying seller, buyer making a cash payment of 76 million, which they received, and buyer issuing units of buyer to seller, representing 25% ownership stake in buyer. Okay, let's not be too hasty here. Let's not be too hasty. I mean, we gotta do some work sometime, right? So the sale closed in May. These are the July financial statements. So it's right here, equity method investment. So they valued it at 100 million. Is that the implication here? $100 million. So what do they still own? And what are they doing with it? Basically, what's left of the business. It's for 70, okay? They sold that. Taylor. So they sold. So they got Vince Wholesale, Vince Direct Consumer, and Rebecca Taylor and Parker. All right. Well, it looks like they're still running lots of brands, and they're not making money doing it. So, despite their new partnership, we are going to pass. That's never a good sign. Profile. Internet content information. Operates audio entertainment, social networking in People's Republic of China. Due diligence complete. By the way, none of this is investment advice. This is all just for entertainment education purposes. And hope you learned something, but always do your own work. And we could be wrong. We could make mistakes, etc. As to why, company, if it's located in China, we wouldn't do it. Simple reason. Most important, we don't know anything about China. Chinese consumer, who the competitors are, very simple. Second, particularly very small companies, it's easy, not just in China, but everywhere, to have issues of, for lack of a better word, fraud or otherwise. So, the farther away from North America we get, markets that are regulated, we understand, disclosures, et cetera, et cetera, et cetera. Customers we understand, competitors we understand, our tolerance for for venturing out just goes down dramatically. Optical Cable Corporation. Engaged in the manufacture and sale of fiber optic and copper data communications cabling and connectivity solutions primarily for the enterprise market in the States. They provide fiber optic and hybrid cables. Okay. So they sell cables. Okay. Is it a good business? Does not appear to be a bad business. But they don't make any money doing it. All right. Optical Cable Corporation. Optical. Third quarter, ended September. Okay, here's some numbers. So margins are not fantastic. Neither are profits. And the balance sheet's not that lightweight. Industrial oil and gas, industrial, military, commercial enterprise. Okay. SEC filings. Here we go. Thank you. Okay. Let's see. Yeah. Various harsh environments and specialty markets, collectively the non-carrier markets, and also the wireless carrier markets offer suites. Products. I'm just trying to see who they sell to, if they give a distribution by or a sales breakdown by industry. "23 acres of land, 11 acres unused in Roanoke, Virginia, 46,000 square feet. It's like $20 million business, market cap. Pays a dividend, 3%. Okay. They own another facility. It's 13 acres, 64,000 square feet. Lease. Okay, that's interesting. We believe that we operated at approximately 50% of our production equipment capacity on average at our collective manufacturers during fiscal 2022. This is determined based on a capacity calculation, and it assumes we would be fully staffed for production of all of our 24 hours a day, 7 days a week, all year. Okay, so that is like theoretical capacity. During a given period of time, additionally. Okay, so they are suggesting that their facilities are underutilized. They hedge themselves by saying it's like all the time, every single day, 7 days a week, 100%, 100% of the time, right? Well, people need days off. Christmas, right? 7 days a week all year means 7 days a week all year, all day. So, it's a theoretical capacity. You just take away holidays 1 day a week. No, you're not. So it's possible that there's some spare capacity here. That's a good thing if they can get the business, but you need to be able to assess that. Okay. Pictures, great. More pictures. Strong sales growth. Okay. More pictures. Wow, there's a lot of disclaimers. COVID-19. Okay. Royalty income. Other income. Okay, so what does their current balance sheet look like? Or most recent? So they don't operate with a lot of cash. Lots of inventory. Non-payable revolver. Long-term debt. Okay. So they're selling below book value, but most of the book value is in receivables and intangible assets. Sales. Had profitable year so far. Oh, that's why. Gain on insurance proceeds received for damage to property and equipment, $2 million. So of the 3.3 million that they quote made this year, 60%, $2 million of that came from insurance receipts due to damage that they suffered at the facility. Okay. Yeah, I think we're gonna pass on this. There. Yeah. You know, a little bit more, but it doesn't seem like it's it's nothing that's wildly undervalued. It's land in Virginia, acres. What was it? Yeah, 23 acres of land. And the facility is 146,000 square feet, Virginia, located near the Roanoke, Virginia airport, a major trucking company facility. So it's well situated in North Carolina, 13 acres, right? Yeah, so and they have some, but it all kind of relies on them getting more business. You want to buy operating business. Also, this is not an industry that we know well, so we're just going to pass. How do you know if you know an industry well? How do you know if something's within your circle of competence? First of all, if you ask, Charlie Munger says, to ask the question is to answer it. That's a fairly good indicator. If you have to ask, your probably answer is probably no. Another good one is, can you name competitors? Does Performance Shipping provides shipping transportation service through its tanker vessels worldwide, its fleet, 8 Aframax vessels combined. Corporate, okay. Greek Shipping, we are gonna skip this one. Shipping's notorious. It's so hard. If you get it on the right cycle, like you can see, right? Like this is just high level revenue went from 36 million to 110 million in like a year and a half, 2 years. Profits went from a minus to $70 million. So there's like this huge boom bust swing in shipping. That's just from 8 ships. But you also have this huge CapEx cycle. So if you have the, the pay, and then there's like regularly in shipping, there's lots of areas for uh, nonsense and issues. Let's just say that. So unless you have some good insights in shipping as to why a company, like we looked at with Algoma, where it's it's well run. The market for those transportation services are pretty well protected relative to just generalized ocean tanker shipping. And you're a dominant player. Basically, are you the big boats in the small ponds, relatively speaking? Then that's something you can potentially look at. But if you just own H8, not even 80 or 808 ships on the oceans, uh, you know, that's yeah, there's so much room there for failure that we're just not interested. We suspect these guys sell oil and gas equipment services to drilling and completion tool technology company, designs, engineers, manufactures, sells, rents, and repairs drilling and completion tools in North America and internationally. Drilling ream. Sorry, back to the earlier point. One way to know if something's within your circle of competence, can you name product competitors? Or can you answer the question, why would a customer buy company X's products versus a competing product? And if you can't answer that with relative ease, you probably don't know. You're probably not there. Like the optical, somebody knows about Superior Drilling products. Like someone knows the drilling solutions, the drill and ream drilling solution. Someone knows that tool, right? Someone actually works with it. Strider, V-Stream. Like these are products that real people will work with and know about. So maybe you were like a drilling repair guy or whatever. Could you get an advantage? Sure. Because if you know their products very well, their sales guys, their competitors, you would actually know this company way better than anyone else would otherwise. And so because of that, then you're going to have an advantage. You're going to have an edge, right? Because you're going to know those products. So if you don't know those companies, the products well, then you just pass. You don't need to look at it any further. It's not necessary. And if you're planning to do work, you also you want to be a little bit strategic because it takes a lot of work to really understand a business. It takes a lot of work to really get underneath it. And if that's very singular, in the sense of if there's one company like this Algoma Corporation, the shipping company, marine shipping, the Great Lakes, we're only aware of one company, that's Algoma. So imagine you do all this work, try to understand the business, try to understand that, like what the assets are worth, try to figure this all out, and all you can do is buy one company, and it's like a so-so deal. Like that's not worth your time and effort and money because you're just not going to make a lot out of that. So you can pass. But if you were to study consumer packaged goods for whatever reason, and someone asks you, why is Coca-Cola, who's Coca-Cola, who competes with Coca-Cola? What products compete with Coca-Cola? Well, you can easily name Pepsi. You can probably name a bunch of other different sodas. Sprite, orange, orange pop, grape, whatever, right? Dr. Pepper. Go on. The list goes on, right? There's probably a whole bunch of new niche sodas, like you get those, maybe some fancy waters or all that stuff. So the point is, And more than that, there's a lot more consumer packaged good product companies available on the market. So if you're able to develop because of what you do for a living as a job, or because you just are interested, then it is more likely that you'll have uh, better odds in picking those companies within those spaces that will A, do well, and B, that will at the right time. So when everyone else is panicking and selling Coca-Cola, people don't want to buy Coca-Cola, they use too much water or whatever. You're going to the store going, people still buying Coca-Cola. Then you will have an advantage over the rest of the market, and you can just afford to wait. So, yeah, I think those are some pretty easy questions. If you're really wondering, should I take a look at something? If you don't or can't immediately understand uh, name any of the competitors of a business, or why their products are good, or why a customer chooses one of their products, then you can just move on safely. Say, next. And there'll be something out there that you can't understand. Okay. Flexible Solutions International, basic materials, specialty chemicals. These guys are based in Taber, Canada, Alberta. Wow. Manufacturer market, specialty chemicals that slow evaporation of water in Canada. Okay. Energy water concentrate, biodegradable polymers. Yeah. The company offers thermal polyaspartates. So to oil fields reduce scale and corrosion of various water. So being able to, if you struggle to pronounce the word, that's a good sign you should pass. So for these guys, we're going to pass. We have no idea about the thermal polyaspartate market of chemicals and who the customers are and who the competitors are and why one performs better than the other, et cetera, et cetera, et cetera. None of that. Imperial Petroleum. Yeah, another Greek shipper. Provides international seaborne miners traders. Yeah. There's nothing wrong with the business. If we pass, it doesn't mean there's something inherently wrong with the industry or the business. It just means that are you, as an investor, able to look at the company, or can you predict that, if you were to look at this company, assume it's cheap, that you'd be able to reasonably conclude whether or not it's a good deal or not, right? So investment holding companies provide securities brokerage, corporate finance, investor advisory in Hong Kong. Yep, we'll just pass. And we do not need to do a lot of stuff. You better do less stuff than a lot of stuff. So if you have an opportunity to do something that you really understand, you can do bigger versus doing a whole bunch of little stuff that you have no idea about. Consumer defensive farm products industry. Longmount. Engages in breeding, growing, processing, and selling of alfalfa, and sorghum seeds. Offers sunflower, stevia. Okay, so it's a seed distributor. Fine. Financials. $70 million, that's a lot of seed. Okay, so let's see. If we're looking at something, it doesn't mean that we're going to do it. It just means that, we'll take a look. Sometimes you should be just generally interested, right? If you see a company you've never heard of before, a company that's doing something that, an industry you never thought of before, like seed breeding, take a look. Take a minute, exercise a little curiosity, and you never know what you'll find. So June 30 year end. and they corner the market on alfalfa and sorghum. Now, if memory serves, sorghum is not a large crop in the United States. This good. Where's this is you must okay. DRG News. DRG News. Growers planted 6.8 million acres of sorghum for all purposes this year, up to 8%. Up 8%. Sorghum top producing sorghum state, Kansas and Texas. Okay. So since you know which crops, let's see the alfalfa acres planted. The USDA gives sorghum acreage planted by county. Yeah, so there's good. So there's good data on this. What's the alfalfa? Alfalfa. News release. New seedlings. New seedlings of alfalfa and alfalfa mixture in Wyoming are up 35,000. This is a news release from the USDA, by the way. And keep in mind, like, there's all when someone says alfalfa, there's like strains and breed. Like, farming is its own world, right? Corn is not just corn; it's different types of corn. They just kind of everyone says corns. There's not just one corn plant or one wheat plant. But there's clearly good data, right? Lots of alfalfa hay. This is 2018. There's clearly good data. Anyways, again, interesting. Now you know that this company was something you want to look at. You can actually get. We also have a commercial market presence, whatever that means, in pasture and sunflowers. So, and they operate seed cleaning and processing facilities. So it's like a service business. Yeah, so they breed, so they make seeds. Sell over 600 seed products. Australian wheat, stevia. Yeah, so they sell seeds, not plants. Okay, so let's see what how they're doing financially. Seed business. What does that look like? Revenue 2023, remember ended June, $73.5 million in seeds. Low margin, as we would expect, 20%, up from 9%. So they doubled margins in 2023 versus 2022. But they lose big money on their operation. Where did they make money? They sold the business interest, 38 million. Yeah, so the last couple of years they've just been losing huge. Most of the sales in US, Australia, and Saudi Arabia, Mexico, Libya, Sudan, Pakistan. Okay, so US, Australia are the biggest share. Okay, how's the balance sheet? The balance sheet looks to be not strong or not awesome. A lot of cash. Got working capital lines of credit, $50 million, $3 million in cash. So what's this selling for? $30 million. Yeah, we will gonna pass on this. We wouldn't be too optimistic about the seed business. It's also going to follow farm cycles, which are historically cyclical. So our understanding of farm cycles is basically, which is like very basic. Prices for something goes up, farmers plant a lot of it, which means demand for seeds goes up. Then because they produced a lot of it, prices collapse, and they don't plant a lot of it, which means seed demand goes down. Right? Certain things maybe have more stable demand patterns for volume, but that's the basic idea. Good Times Restaurants. Company operates and franchise Good Times Burger and frozen custard, upsell quick service. And bad. Okay. It's a restaurant company. $138 million in sales. Wow. Good Times. Okay, so it looks like chicken sandwiches. It's a decent mix of products. At least the food photography looks good. Maybe we're just hungry. Paw Benders? Say Paw Benders. Oh, dog cups. Okay. All right. Can we see prices? Burgers. We cannot see prices online. Start order. Block. Block. Just. Okay, so they got 10 locations in Denver. All right, so order now. Why would it start me with my drinks? Breakfast, drinks, dipping sauces. I can't even see lunch. Current menu. Full menu. That is annoying. I understand why they do it, but like that's kind of the best solution. Who's thirsty? What's their breakfast wrap? Sausage, egg, and cheese burrito. $3.99, $3.69, $7.49. Make a combo. Price varies. Why does the price vary? Full menu. Burgers. We like a good double cheeseburger. Who doesn't? $7.29 for a double cheeseburger. What does McDonald's charge for a double cheeseburger? McDonald's. Website. No. No. Stop it. Too many things. Okay. Order delivery. Won't let me click it. My goodness. Search for another restaurant. Wow. Okay. Why can't I order delivery? Order now. My McDonald's. Continue. I gotta download the app. Oh my god. DoorDash. Continue. Just Denver. Yes, Denver, Colorado. 5 locations. Order from the store. I don't care. Just let me see the menu. You gotta really want McDonald's. Like, oh my god. I just want to see the menu. Now I can't see. Oh, wow. I can only see breakfast because only breakfast is being served. I gotta click down. Lunch menu. Cheeseburger. Double cheeseburger. Okay, there you have it. So double cheeseburger in Denver, Colorado. $4.49. Good Times Burger. Double cheeseburger. $7.29. Twice the price of McDonald's. Wow. Man. How the hell do you compete with McDonald's on twice the price? Latest 10K. But okay, so in December 2020. Okay. 10Q. Balance sheet. Balance sheet's not bad. Like these lease liabilities, like it's a restaurant company, of course, gonna have lease liabilities. So if you know you're basically all your liabilities, lease liability, that's like we don't really look at that way. Accounts receipt payable and other accrue. This other accrue being 6 million versus accounts payable. Like we expect our suppliers to be more, so we're not sure what this is. Maybe it's like salaries or whatever, but I don't know. But they have a decent like. But this balance sheet looks pretty good for a restaurant company. Sold sales were $100 million year to date June, $35 million in the quarter, and let's see, labor costs 35, 103, 35%, 33%, 32, 30%. So okay, occupancy cost looks like 7% or thereabouts, 7, maybe 6%, a little bit lower. 7%, pretty much bang on, which is good. It's good if your rent is that, but unless the rent is being allocated somewhere else. Okay, so what? So why did income from operations go up? Why did income go up so much? There does not appear to be anything special. Same amount of revenue, same operating costs. Income from operation 1.3 million. Income before tax. They got a provision for income tax of $10 million. I'm not sure why they got $10 million in tax back, but that's what it looks like for this year. So Man, yeah. So it's tough business. This is tough business. Like they're making a go of it. They're selling. They obviously got a lot of sales. Clearly, they have a fan base for the products. But that is you are selling at a massive premium to just McDonald's. And not that McDonald's is necessarily the gold standard. Obviously, there's differences in the products and differences in experience. Fine. Burgers at 7 and change. And the same burger at McDonald's is like $4, and they got maybe a bigger menu. That's oh, and most of their business comes from this Bad Daddy's. Right. Okay. So, but Bad Daddy's is full service. Good Times Burger is quick service. So McDonald's comparison is appropriate for for Good Times. What about this Bad Daddy's franchise where most of their money is coming from? Bad Daddy's. Okay, let's look at the menu. Okay, select location. Oh, okay. Yes, burgers. What the heck? Oh my goodness. Bacon cheeseburger on steroids. Badass burger. 2 5-ounce Angus beef patties. Buttermilk fried bacon. Horseradish. Oh my god. Getting a stomach ache just reading this. Daddy's Philly. Magic mushrooms. Okay, so they have so this is much more kind of, or maybe not artisanal is the wrong word, but certainly not just your standard burgers. You got chicken. Okay, let's look at the menu prices. How much are they selling this stuff for? Black. Delivery or pickup? Oh my god. Pickup. I'll do all this stuff. Pickup. We're looking in Denver. Okay. Order ahead. Burgers. Wow. $15 for the burger. $10 for the all-American burger. What do you get for an all-American burger for $10? Okay, looks like the 7-ounce patty is standard. Medium. Okay. And then cheese is extra. $1.25 extra for a slice of cheese. Oh my god. No sides. Green chili cheese tots, $7. Truffle parmesan fries, 6. Okay. These guys are not the low-cost option. These guys are not the low-cost option. Okay. What do their stores look like? These. Maps. What do their stores look like? See if we can get a good location sighting. Penguin. Bad Daddy's Burger Bar. Okay. Just want to see the store. Mattress. Okay, here we go. Okay. Looks like a decent design. Are there any images from inside the store? Okay, so it's like we get it. I think we get it. Yeah, so this is something that we want. Let's look at one more of the 10Ks. Something that's a little bit older. Annual filings. Let's look what else. See what happened to the pandemic. To the financials, we assume they got crushed, but so did every other restaurant. Sales, rock solid. Well, impairment of goodwill or whatever, impairment along with assets, fine, but that is actually impressive. Hmm. 138 million, 2022, 123 million, 2021, 109 million, 2020, 110 million. That seems unbelievable. $17, $79 million, $64 million. So they've been growing. They've been growing. That was in 2013. Whoa. Hold the phone, people. Hold the phone here. Good times, good times. G10. So, in 2022, sales 12, $19 million. Percent compounded sales growth rate. Well, darn it. Now, probably should look at these guys. Okay. That is that's an impressive growth trajectory. Because they flat during the pandemic. Like, think about that. It's a restaurant company. Good, Bad Daddy's reviews have like they don't even have stunning stellar reviews. Yelp 4 stars, 3.5 stars. What? Indeed, 3.5 stars. They pay their people not a lot. Glassdoor 3. What? Grubhub, 4.2 stars. We are confused. We are very confused. How does a company, restaurant company with at least online reviews that are, we would expect 5 stars, right? That are kind of average, sells a product it's twice as expensive as going to McDonald's, the gold standard of restaurant quick service. And how do they grow sales 20% per year for a decade? That is a puzzle, and one that really should be figured out, should be looked at carefully. Not many companies grew through the pandemic. Definitely not many restaurant companies. Definitely not many restaurant companies. Okay. Well, now the downside is that it does not appear that they are profitable. That being said, that being said, um, like it doesn't appear that they're profitable, but hence is even the greater mystery. Able to grow for a decade, right? And yes, they have franchising, but you've been able to grow for a decade. And like your best year of profitability was most recent because of a tax gain. Oh, here we go, 2021. Gain on debt extinguishment. Like their income is coming from like these gains, extinguishing debt, taxes. Yeah, losses, losses. So who is financing this decade of losses? Who is financing this decade of losses? Darn. Borrowing. What does the balance sheet look like? It's all leases. That's all leases. Okay. Okay. Uh, we'll cut it there. Okay. And we'll try to some data in on this company. So this is a mystery. They've grown top line 20% for a decade. Their online reviews appear to be nothing extraordinary, either for their employees or for the customers. They grew during the pandemic. The company is selling for $30 million. Definitely have this to definitely have this to watch list, but company selling for $30 million. No income. Cash flow is benign relative to investment. And yet, not a lot of debt on the books. How many stores do they have? I presume it's, and they're selling products that are twice as expensive as McDonald's. How they do? How did they do that? 39 store total, 62 stores. That was in 2023. Stores. How many stores they have a decade ago? Has it been all store growth? Or growth in number of stores? Okay. Same store sales growth. How many stores do you have? So that's interesting. So they sold underperforming restaurants for cash and purchased two high volume franchised restaurants from franchisees. So that's an interesting one. Maybe they bought up their franchisees. But where they get the money to buy their franchisees? Okay, so Bad Daddies, there were 8 in 2013, and there are 39. Okay, so in the decade, it went from 8 to 39 Bad Daddies. Criteria is highly differentiated concept exhibiting high customer loyalty. Unit economic model exceeding 40% cash on cash return. This is in 2013. You're so confused. Not a lot, so it's mostly owned. It's mostly owned stores. These Bad Daddies. Which is typically a good thing. Like typically, if you own the restaurant, get money. A lot of franchise stuff that like if you think of it, right, like look at Chipotle or Chipotle. I don't think they do any or like very, very minimal, or even if any. So they're averaging sales 2.5 million per store in 2022. What? What is Bad Daddy sales? 40 stores in 2020. Okay. Average store is doing 2.5 million. Off-premise sales average $29 per transaction, while on-premise, so the average sale, average ticket is 36 bucks, which means let's assume that like that can't be for one person. Might not. It's got, I guess it's a $15-$20 meal, right? What do we figure out on the menu? There's fancy burgers like 15 bucks a pop. So yeah, it could easily be 36 bucks on average. Guy gets burger and fries, it's 20 bucks. 2 people is 40 bucks. Yeah. Average per person check is $14.17. They believe it's slightly lower than the average check at fast casual, such as Habit Burger, Five Guys, and Smashburger, but well above typical. Right. Okay, so they acknowledge that. It's fine. So just focusing on quality, right? Sales growth. Yeah, what the hell? This is literally blowing our mind. There's 21 Good Times Burgers, 23 Good Times Burgers, 2 Good Times Burgers. Eddie's. Okay, here we go. Average annual unit volume, 1.45 million. Range from a low of 800,000 to 2.4 million. Bad Daddies. You guys are doing 50 grand a week. Total store operating weeks. Average was making $2.5 million, 2.6. But then where's the profit going? Okay. We are going to tap out here and call it a day. I think tomorrow we're going to look at least we'll do getting some data together for this Bad Daddies. Because yeah, this is literally blowing our mind. It's strongly growing. They charge more, a lot more, so it's a premium price product relative to other quick service restaurants. Maybe not in their niche, but they're clearly offering value to the customer. Growing fast, so it's worth a closer look. Because you're buying the whole thing for 30 million bucks. But they're doing like over $100 million of sales. It's not easy to build a restaurant chain doing over $100 million sales, and you get to buy today for 30 million. Our profits have been elusive, but maybe that's all growth. You know, gotta have to dig a little deeper on this one. Okay, and it's hamburgers, so you can easily understand what the hell's going on. Well, that's it, folks. Thanks for joining in. We'll see you next time.